Once again, hello everyone. My name is Kamal Manocha. I represent PMS AIF World. We have been doing Friday webinars for last almost 4 years, and the process continues. Despite anything, today I was traveling, not in my office, so I borrowed somebody else's office to kind of perform this webinar because, as I said, the process of webinar must continue, and especially now it is all the more important because we have been seeing that stock markets after kind of a rally over the last 6 months has been showing some kind of resistance, some kind of, I would say, reluctance in kind of further rise. We have been seeing a lot of macro factors, which could be rising US bond yields or, in Indian context, the quarterly results which have been coming are kind of less than expectations. And at the same time, valuations have become expensive at the small cap side. There is a, I would say, word of wisdom going around amongst, I would say, fund management fraternity that this is the time to invest maybe in large caps, but time to exit small caps, or maybe be being patient on small caps because small caps have actually rallied a lot. And hence there is a valuation gap, which kind of makes case against small caps. That is the reason we thought that in today's webinar, we'll invite Jyoti, who is a thought leader from the space of small caps, because his PMS, which is Valentis Advisors, is doing really well and is giving very good consistent performance over last more than 5 years. So, Jyoti, very warm welcome to you to this
Thank
webinar.
You.
So this is a kind of a, you can say, a very candid discussion that we want to do for our clients. And I have set the context for you. I would want you to give your opening remark and opening thought on, whatever I have said, and whatever word of wisdom is kind of, going around in the market today, which I honestly do not kind of disagree to, because there are investors who would want to continue to invest in small caps, as the recency bias always kind of is there. But this is the question for you, because I'm sure you are adding more and more clients every day, every week, every month. It would be difficult for you to not invest. But at the same time, I'm sure you would have some magic sauce or some insight which others do not have, because that is your area of forte. So as a second part of this webinar, I wanted to cover that aspect also, that where opportunity lies. So over to you for maybe giving your remarks.
Yeah, thanks, Kamal. So, I don't disagree with a lot of points you've made. So first is, let me go to the broader market. One area which I disagree with you is that the results have not been good. I think the results have been good. In fact, even now we've seen earnings getting upgraded rather than downgraded post the results. So they've not been spectacular, but they've even now beaten analyst expectations which are there. So in fact, India is standing out a lot. If you look at India versus, let's say, US or anything, India this year will end up with earnings growth in FY24 of close to 20%. One can argue whether it's 19 or 21, but close to 20%. US at the same time is going to do earnings growth. If we are lucky, they'll do earnings growth of 1 or 2%. So, there's a wide disparity. India is doing well relatively. Also, India is well acknowledged. In fact, I was in Hong Kong a few weeks ago and met a lot of the large institutional investors who invest in India. And for the general consensus is India is the place to be for the next few years. So fundamentals are definitely in favor of India at the moment, and it's ours to lose. Unless we do something really stupid, I think India will be into favor. The second point, and that is more critical, which is why a lot of us are concerned on the market just now, is the valuations. So the valuations are not cheap. They're not cheap in an absolute context. India probably trades at between 5 to 10% premium to what has been a long-term average on the large cap side. Again, if we look at India in a relative context, India trades at close to 90% premium on a PE basis to what the MSCI emerging market PE is. So, for anybody who does emerging market funds, if he buys India because he likes it long term, he's paying 90% more than what he's paying for the rest of the basket. So to that extent, I think India will trade at a premium, and it's historically also traded at a premium, but the premium will be more like 55-60%. So people will be happier to buy India if we get a correction, and that's the reason we are having some of the sell-off which we are seeing. Third is, of course, global factors which affects us, which affects everybody. There's whatever the conflict going on in the Middle East, but I think the more critical is what the 10-year bond is. because that is close to 5%, and that is a bigger danger signal really for the market. Now, if we come to small caps and mid caps, they've like had a spectacular run, right? So whatever way we cut it, small caps now trade at probably parity or to what the large caps trade at. Historically, they trade at a discount. You want to buy them at a discount. The other way to look at it is, if we take the last 1 year, the small cap index has done like close to 28-29% return. The large cap has done 7. So, you've done like a 22% sort of alpha over the large cap, which is high by historic standards. So when that happens, going forward, it is possible and it's likely that at least for some time, the small cap tends to underperform the large cap, and you tend to, make more money in the large cap rather than in the small cap. So that would be like a very broad brush to it. So do you then, not buy small caps now? Is there a reason to buy small caps? And what should you do? So one is, in the economy which is going up, the small caps tend to do larger the earnings growth than what a large cap does. There is a very broad brush. So you want to buy small caps because they'll grow earnings much faster than what large cap will do. So my guess is over the next 5 years, small cap will do earnings growth which is at least 400 basis points more than what a large cap index does on a very broad basis. So that's one reason why you should buy, and you probably may end up making more money in a small cap over 5 years than you would in a large cap, even though you're buying small caps at a time where valuations are probably elevated. The second is, and this is what we are doing in our fund, we are obviously getting a lot of money coming through in the fund. So we are like saying that we don't want to put all the money today when you give it to us. In fact, we are telling all our investors that we'll probably invest over the next 8 to 12 weeks. We're not going to invest in one shot because over the next few weeks, you could get corrections in the market, you could get pullbacks in the market. And that's really the time we want to keep some powder dry so that at that time we don't end up with we have zero cash and we can't invest in the market. So, if you can get like a 7-8% pullback, you want to do it. The third is, timing a lot of these small caps is like very, very tough because you want to buy them there when they are very cheap. But, if you miss 1 month of it, you probably like lose 10% alpha. And that is like, you probably covered all this. So very theoretically today, I could maybe sell small cap, buy large cap. And if I get the timing right, I may be plus 8%, 7%. But if I miss 1 month and I do it 1 month later, you may find that after all the exercise which I did, then over the next, 6 months, I'm back where I was. I might as well have not done this exercise. And that gets very, very tough because, everybody is a human being. All of us, hear this, that you be greedy when everybody is fearful. But when it comes down to it, it is very, very tough to do. So I always tell people that think of it as an asset allocation approach. If you have like a lot of small cap in your portfolio, you think this is more than what you want to do at a longer term, then maybe you want to trim some of that small cap. But then, you don't want to go into a 0 and 1 situation where you zero small cap today and at some point you have 100%. So think of it as asset allocation, think of where the risk is and try and keep it within that limit. So that would be like a very broad brush. I don't know if you want me to go a bit into detail of how we go about some of these things and what we try to do to mitigate these risks. Kamal, or you want to?
I think, let us do it in a more practical and I would say realistic manner, whereby at present, given the valuations at where we are, right? So how is it that you are managing your portfolio? What kind of cash levels you are maintaining? And how are you deploying fresh money, which is coming from new clients?
Yeah.
So maybe, if you cover that, that will give us full context.
Yeah. So basically, as on date, at a very broad PMS level, we are sitting on 20% cash. So, that sets the context that there is a lot of cash sitting. Second is now within this cash, most portfolios are sitting on like at least 10% cash. So portfolios which have been with us from inception, 7 years old, which were fully deployed at some point, there we have built in 10% cash. New money we are telling people will deploy over the next 8 to 12 weeks at least. So like I told everybody, expect to see a lot of cash in your portfolios. Don't, panic over it because it's not like we've forgotten the money is there, but we are trying to deploy. The last is very practically on like a daily basis. We have some price points in mind that these are the price points at which we would like to buy some of these shares. we keep those shares at those price points every day. So even though, they seem to be far away, and you get days like, yesterday, a lot of those price points got achieved and you got stock at lower level simply because you were standing there to buy at that level. It didn't seem like it would come the previous day, but yesterday a lot of stock came. So that is what helps us when, clients have given us money, because we are able to buy shares much cheaper than, it's like if I say on a broad basis, I think, small cap should correct 10% or 12% before I, want to enter. But in one day, I can get like a 6 to 8% correction already. Then I achieve that whole correction, which we are looking at in the index. So on a very practical basis, we try and put a lot of trades at way below current market prices at levels which we think are fair, and try and, buy it over there.
Sure. And now, going ahead from here onwards, so
Yeah.
what is the kind of sectors or maybe themes that you see, which are like going to be the next big bets within small caps? Like we saw, a lot of money got made, maybe from 2014, 15, 2019, 20, 21 in specialty chemicals.
Yeah.
Right. So likewise, now from here onwards, maybe after a gap of 8-10 weeks, when you're comfortable, when those price points are kind of there.
Yeah.
So I'm sure you would have some plan, some broader understanding of now what is looking more attractive.
Definitely. So, let me just step back. And, when we talk of this, the small caps are expensive. Normally we talk of the index, right? So I just want to give some context and some numbers of like what's expensive, what's not. So last 1 year, like we've done crazily well, right? The index is up like 30% plus. But 1/3 of the small cap index has given a return which is less than 10%. And, even today, nearly 1/4 of the index is trading at like valuations which are what I call classify as cheap, where the trailing 4-quarter P ratios are less than 15. So within that index also there are a lot of stuff which are cheap and which have not done well, and then obviously there are a lot of stuff which have done well. So 1/3 of the index gave a return of more than 50% in this same last 1 year, which probably is like, okay, I don't want to be in that sort of stock. So one is, we are hunting for, things which have not done well, and is there the potential for that to do well in the future? This aligns with our philosophy. So as you know, we have a 3U's philosophy. We buy undervalued stocks. We are happy to buy underperforming stocks. We are happy to buy underowned stocks. So one is we are always hunting in this sort of space where things have not done well. And so, they've become relatively cheaper at the moment. There's a reason why they're not done well. And so the market, is very worried about this sort of stuff. But if we think that over the next 3 years, this can do well, then we want to hunt in that space. Which makes me to the other philosophy which we have, because we call ourselves like a quasi-private equity investor. So we don't do unlisted stocks, but in the whole small cap space, we are always thinking of ourselves like a private equity investor. We do two things like what they do. One is we spend a lot of time on each company before we buy it. Our research extends to 8 to 10 weeks probably. We meet the company, but we also spend a lot of time with what are called 360-degree ecosystem of the company. So we're meeting the dealers, we are meeting the suppliers, we're meeting competitors, we're meeting the customers. The other is, we buy and hold stocks for a long time. So our churn ratio in the fund, like ever since we started the fund, it's now 7 years plus. In 7 years, the churn ratio is only like 16% per annum. So in some sense, we have turned around the whole fund only once in 7 years, which is again exactly what a PE does. So keeping this in mind, so where have we been hunting? We've been hunting in spaces where valuations are still cheap on a longer term basis. Second is where we think earnings growth can be high over the next few years. So even if you buy stuff which is not so expensive today, what you find is that the earnings growth takes care of the fact that you bought it at valuations which were high. And the third is we are looking at stuff which is today, which has underperformed in the last 1 year. So to give you some very specific things, what have this amongst the sectors which have done very badly, one sector has been chemicals. Like you said, this is a sector we did very well for the last 5 years. So the last 1 year, the whole chemical sector has underperformed massively. They're still not cheap. Like, these stocks are done badly because there's a global slowdown. But, they have got re-rated massively in the 5-6 years. So they're still not coming out to be cheap stocks for us, but it's something which has come on our screens back again, because for the last 18 months we are struggling. Here we find one or two stocks which are still relatively very cheap. Now the other sector, and this is like the beauty of that sector, banks have been one of the best performing things in the last 18 months. But within banks, there are like 4-5 stocks which have been massive underperformers through that period, and they are very, very cheap. So, in the banking space today, I would say, like, if you think of the whole, sector-wise breakup, probably banks are still something which seem like very cheap space. It's a sector which will do well in earnings also the next few years, and you're starting with not a very expensive valuation. It's not as cheap as obviously as it was a year ago, but it still is like a very cheap space. So that's one space which we are looking at very, very closely, and we probably have got a lot of exposure there. We think we'll be adding to banking space as things correct, and probably we'll be buying more. I don't know if you want to ask a question. Otherwise, I could give you 3-4 themes which we have very broadly in the market.
Please, absolutely. That is the obviously context that we want to understand. What are those things?
So very broadly, we think over the next 3-4 years there'll be 4 themes which will play out in India, and so some of these things, the sectors will fit into this. So first is Indians will get richer. So our per capita income will double from $2,500 to $5,000. Now, as Indians get richer, what do they buy and what do they spend on, and how do you make money out of it? So one thing which I always tell people, please remember this: people will not buy the same thing they bought when a per capita income went up from $500 to $1,000. So people are not going to buy soaps and shampoos again. Like, that is well penetrated and people have already bought it. People will move up the chain. They'll buy more luxury products. Unfortunately, what this also means is some of the stuff we buy will not be from India. People will buy more expensive, luxury, branded, Italian purses and things like that. But there'll be a lot of stuff they'll do in India. So, people will travel more, people will holiday more, people will spend more on fitness, people will do up their homes much better, people will buy houses. There'll be more of, just the way the generation is. You'll probably take more retail loans. So some ways to play this are, through the banking space, which, will benefit from people borrowing more. Second is, we are quite positive on the home builder space because, it's ancillary to real estate. So real estate will do well as, people will do up their homes much better. And so that's, one way to play it. The third is, the whole anything related to tourism. So if you take the hotel industry today, you take, the travel agency industry today, they'll do very well. Like hotel rates in India are like really expensive now related to most parts of Asia. And in fact, I keep joking that probably it's cheaper to get a room in New York than it is to get a room in Haridwar, probably. It's reached that stage. So these are things which are all coming because Indians are going to get cheap, getting more wealthier and they're wanting to spend more. The other theme is, the capital expenditure theme. So what we've seen over the past few years is that the government has spent a lot of their budget in capital expenditure. Like one reason we preferred capital expenditure over consumer names is that relatively these were very underowned and very cheap earlier, and the consumer space was more overowned. The other is if you see government capital expenditure as a percentage of GDP, it's gone up from 1.1% to 1.9%. So there's been a massive shift there. Whereas, things which help the consumer demand like subsidy have gone down. So capital expenditure will be one theme. Hopefully over the next few years, we'll see the private capex starting also. And that will be a big driver for, the growth in capital expenditure, capital goods stocks. So within that, we obviously like capital goods, but a lot of them had a great run. So I think the margin for error is quite low there. You have to have great visibility on earnings to justify some of them. Other way to play it is banks. So, and that has been one area where, banks have done badly till like a couple of years ago. All the retail banks did very well till 2 years ago, but all the corporate banks were struggling with NPLs. The cleanup has happened. So a lot of these guys will see growth because, there'll be more corporate spending on capital expenditure. Plus the books are much more clean now. So that will be like another way to play it. Within the whole capital expenditure space, there are going to be a lot of sub-segments which probably will do well. Like one thing which we have played in our fund and done very well with has been the pipe story, because the government came with this Har Ghar Jal, And so the pipes were one great area where, people did well with, and we really participated in it. So we continue to like some of these stocks. They're not very expensive, though they perform very well. The third area is going to be China plus one. So that's very interesting. China plus one, we played through chemicals, we played through, some of the white good manufacturing spaces. It's got played out to some extent. So because now the valuation in this space is not very, very expensive. I think one area where there's probably a lot more ability still left has been the auto ancillary space, because that also will be part of China plus one. And, like I am coming with a new word which I call China minus one. So what will happen now is, going forward, a lot of companies in Europe, especially, they are saying that we not only don't want to buy stuff from China, but we also want you to certify how much of your components have come from China. So, we want like the Chinese component also in your end product to be very, very low. So, which is, they don't want China at all in the whole, product. So this will start helping countries like India, where people will say, okay, we can't get components from China. We want to buy from components from India. And so, we'll start to see some of these companies shift their outsourcing to India from China. And, so auto ancillary is one space. I think there'll be another big thrust there in engineering companies. So just watch out for companies who are probably going to participate in this whole space where, if they are MNCs, then, the MNCs will outsource more from India than they've done in the past. And we own a couple of such companies where, people are shifting their production base from China, from Taiwan. They're saying we want to shift 25% of the production to India now. So that will be one very interesting space. Pharmaceutical continues to be like one area where we are strong on, and where we'll probably keep doing well, as people want to diversify their base away from China. So that's like the third theme, and the last theme, and I want to end it quickly so that you can ask questions, is digitization of India. So it is like, it includes software, it includes, telecom, because you want more 5G, and it would include some of these new age players, which we don't own at the moment, but some of them will be really big winners and you want to participate in them. So these are broadly four themes which we have for India, where, one can hunt for ideas, and there's still stuff which are cheap where you can find good stories there.
And what are the views on IT sector? Because IT sector has also been correcting for some time, and you have not covered that in your earlier conversation. So I thought of kind of reminding you on this.
Yeah, so IT is very interesting, because 18 months back we had a theme where we said that buy local, avoid global. So we were actually zero weight on IT for the last 18 months, and there were two reasons for it. One is we were worried on the global economy, and the other is the sector had done very well. So now whole three views it does not fit, because it's actually the outperformers which you want to avoid. And the third was that valuations had become very expensive. It's now starting to fit on our theme, probably like on our screens have been showing up, and it's something which we debate a lot internally, that when do we start playing these, because two things are working out. It's like relatively much cheaper than what it was 18 months ago. It may not be absolutely cheap, but it's coming into the maybe undervalued sort of zone. Second is, it's like, underperformed a lot, and so it's throwing up. We think that there is probably some more bad news before we buy. So what we are looking to buy here is, when do we get bad news? And the bigger the bad news, the more we want to participate in the sector. So, I'm still a little worried about the US economy going into next year. I think the first half of next year will be tough for the US economy, with bond yields being where it is there, and Fed saying that we are into higher for longer interest rates. So, it is only where we see very visible signs that the economy starts to slow down, that you are going to, make the Fed move, and the whole narrative will shift to, we are moving away from like a tight monetary policy regime to a much looser monetary policy regime. So it's something we want to buy. We're looking for bad news, and my guess is somewhere in the early part of next year is when we will be adding to IT stocks in our portfolio.
Sure. So, we saw every time whenever market rallies, there is a kind of a reason behind that rally. And that reason is discovered over time. Investors kind of find that reason over time, and hence maybe misinvesting early. Like, after COVID, it was a very unpredictable possibility when whether market will recover, it will take how much time to recover, but it was kind of a V-shaped recovery. And then later on, it was understood that because of low interest rates, there was massive liquidity, and that liquidity drive the kind of
Definitely.
markets, right? And then at times, low valuations drive markets,
Yeah.
or maybe growth in earnings drive markets.
Yeah.
What is it that you think now? Because at this point of time, all of us understand that valuations are not cheap.
Yeah.
Valuations are kind of definitely towards being expensive, and liquidity is also tight because interest, again, as you know, bond yields are high, interest rates are rising because of macro and unpredictable macro environment. And then the third factor, which is growth in earnings,
Yeah.
that is, as you mentioned, that growth in earnings is fine. It's like in line with expectations. But as per my understanding or whatever media articles I have read, especially for the large cap companies, which sets the narrative, the results over last couple of weeks have been kind of on the mediocre side.
Yeah.
So and my understanding is that two of these three factors should be there for actually market to do well.
Yeah.
Like during COVID time, the two factors were liquidity and valuations. Because of fall, valuations had become attractive, and then liquidity had come.
Yeah.
So now at this juncture, what do you think from here onwards? How is it that the next, say, 1 year market will pan out? What is your perspective, given your 3 decades of experience, or if there is any fourth factor which
Yeah.
is there, which I would love to learn?
Yeah. So definite. So, one is, I agree with all the three factors which you said, and that's like very important. Now, if we go through each one of these, uh, I'll give you my views, and then I'll give you a devil advocate view also, which is different. So one is, I agree with you, valuation is the constraint, and typically when we invest in these sort of valuations, the 1 year return is not very strong. We get into more like a single digit return in the market over 1 year rather than like a double digit return, simply because you get your earnings growth, but valuations start to compress a bit and we don't make money. So that's why I have my classic view is we are probably still going to see a price and a time correction. And probably for the next 6 months, if the markets do nothing, then you would have got your valuations coming back to normalized levels. The second is, I still think earnings growth will be strong. In earnings growth, we always have to look at a bit of relative factor also. So what you're going to see is earnings growth in the world is going to get scarce because everywhere we see interest rates which are much higher than what they were 3 years ago. And you got a big bump up from COVID because the base was very, very low. So everywhere earnings are going to be much weaker than what you saw like in the last 2 years. But in India, earnings growth will still be healthy. And so what you're going to see is people chase growth, right? And they find, okay, India is one of the best places where we are getting growth. And this is not just 1 year. You're probably going to, if you have to take like a poll of most of the large fund managers in the world, they'll all say that, okay, next 5 years, if there's one country which I think is the fastest growing in the world, is going to be India. Very stable and it's going to grow very fast. So that is one thing which is going to be a big positive for India. The third is liquidity. So, liquidity just now is like very tight, but probably interest rates have peaked. Like my guess is, and everybody will have a view on this, but Fed is more or less done with the interest rate hikes. We probably may have one more increase coming somewhere along the way, but we are more or less done. So if you think of, bond deals in US, if the 10-year is at 5%, it's scary. But is this the peak of the bond deals? Like some of the big, bears on the 10-year have now, covered their shots saying that, okay, at this price, we don't. So, one is if the 10-year bond starts coming down and it comes down to, let's say, 50 basis points, 75 basis point, that delta change becomes positive for the market. The other is, my expectation is in the middle of next year, the Fed will probably start cutting. So it may be probably the third quarter of next calendar year or late third quarter of next calendar year is where you start to see a Fed cut. So the same thing which we spoke about, that after COVID we saw cuts starting from Fed became more aggressive. They started to do that. Now, what this will depend on partly is how badly or how well the US economy does. So the worse the US economy does, the faster will be the cut, and the more stronger will be the cut, that you'll probably see more cuts coming. So to that extent, what you have to think is, do we want a slowdown or do we want a Fed cut? My view is okay. We want a Goldilocks scenario, which is not too deep a slowdown, not a recession, but we want some slowdown in the US so that the Fed at least starts to cut. So overall, it would be like, I think the first half of next year will be a tough year, where with these valuations and probably like a bit of question mark on the US economy and the Fed not willing to move and start cutting rates, markets will struggle a bit. But probably as we move later part of the year, we would have a time correction in India, which would have brought valuations a little cheaper. And then, you'll have more positive news coming on this. The last thing which I'll add on India is we have elections also coming next year. So to that extent, the general thought is around elections, the markets tend to be very volatile. My view on a longer term basis is it doesn't matter too much. Like if you just do a very, objective analysis with no subjectivity, just take pure numbers. Is there a difference in either the GDP growth between various governments or the stock market performance between various governments? The answer is not really. They more or less perform the same. But in that one period when the results come, market do tend to be very volatile. Let me just make one more point. So I said we'll do the devil advocate. So, today all of us are looking in a very historic context and saying markets are expensive. Because, for me, like, I am not used to paying 20 times. And historically, when, markets have been 20 times 1 year forward, you've not made too much money over the next 1 year. But it happened in Japan. And so, I don't know if we'll see some sort of Japanification of India, where for like 15, 20 years in a row, the whole world was very excited about Japan. And the valuations kept going up and going up, and they went to like absurd levels. And beyond that, it took for 20 years, then the Japanese market did nothing. But for the first 15 years, when we saw this massive re-rating, what you saw is that, you could have bought Japan at any time when it was expensive, and it became even more expensive. So I don't know if India gets into that stage where everybody wants to own India. And so it remains expensive for quite some time till people have had their enough stay in India. So maybe what is possible, and this is not my base case, but just playing a devil advocate, we'll not get markets as cheap as we want it even in the next 12, 18 months.
I think quite fair. You have, I think, done full justice to your wisdom, to your experience. So absolutely, I think this is quite, valuable perspective that you have brought, that yes, earnings are fine and they may continue to keep doing well. Valuations over time, because of time correction, will kind of start to look fine, and interest rates have peaked, and obviously the outcomes of elections could lead to further upward move. And throughout, now India is accepted as a premium stock market in terms of valuations, because everybody is looking at India. So obviously this sets again narrative very positive for kind of one to maybe add more to equities. As market falls, it becomes all the more attractive destination for one to keep investing. Since you are at the moment, over last say 5-6 years, a fund manager who's built a very good name in the space of small caps. Now, as your AUMs are mounting, are you kind of not finding it difficult to manage with the space of only small caps? Would you want to add a flavor of mid caps, or maybe rather than holding cash, if you find large caps attractive, you may want to add large caps? Because this is the I would say practical and realistic problem I have seen a lot of fund managers have gone through, especially in the small cap space. And then they try to kind of do these changes, but then obviously if one is aware as an investor, before a fund manager does these changes, obviously sets the expectations right. What are your views in this regards, and what are your thoughts in this direction?
Yeah, Kamal. So see, we've done a combination of all of these. One is we have like two funds. So one is the Rising Star, which is our flagship fund, which does like small and mid cap only. So there we don't do large caps at all. And primarily 70-80% of the portfolio will be in small caps. So we may have some large caps, but generally some mid cap, but no large caps. The other is we have a second fund, which is a multi-cap. So what the multi-cap does is it has like roughly 1/3 large cap, 1/3 mid cap, and 1/3 small cap, with some flexibility to do like a bit of different percentages depending on how we see. So the reason we prefer to stick to these two funds is I always say either the investor does asset allocation at his level or he tells us to do the asset allocation. So in the multi-cap, we do the asset allocation for him. We decide how much to put in small, mid, and large. Whereas there are many investors who do it at their level. So there will be, okay, I want X percentage of my money in large caps. I put it through ABC funds or mutual funds. And I want some of my money in small caps, so I've given it to you. So I don't want you to now decide to do large caps in this, because then suddenly I'll have a very skewed large cap in my portfolio. So I understand that you can only do as much as what the small caps do. There'll be a time where the small caps will do badly. There'll be a time where it will do well. And so, that whole small cap fund is aimed for people like that who have said, you do only small cap in this, because in our whole asset allocation framework, we already have some other funds which we have, which are probably mid caps and large caps in their nature. So that's what, so here, our option then becomes that, okay, we can hold some cash, but most of the time we are trying to think of just our core philosophy. We want to buy stocks which will do well over the next few years. We know there'll be a point where it will not do well, it will underperform. But then, when the cycle turns and, as long as we think over 3 years, we can make high alpha on the stock, we are willing to buy it even at today's prices. And frankly, since we started the fund, in fact, we started it 5 weeks before demon. So we saw this, downturn very, very quickly. Like out of the blue, demon came. And in our first 2 months, we suddenly saw negative coming in. But at that time, if we go back into history, the demon happened in November. Markets did badly up to December. But then Jan, Feb, March together gave you like a 11% return. So just being, 1 month late, Jan gave a return of 9%. You were 1 month late, you lost that whole 9%. And then, and then we've seen it subsequently also. We saw in COVID, right? No one in March 2020 would have predicted the sort of returns we got just after COVID.
Absolutely well said. So, another very important aspect which I thought we should be covering in this webinar is what is your view on some of these newly listed businesses, especially in the new age type of businesses. We have seen, of late, for example, stock of Zomato kind of zoomed up from lows of 40-50 to almost doubling and more than doubling. And then maybe same trajectory could be followed by other stocks like Nika or BB Fintech, Paytm, till some time back, everybody was like selling those stocks, and there was this kind of a thought that these businesses are like, I do not know why even SEBI allowed these businesses to come up for an IPO. It is actually, wealth destruction for retail investors who do not even know that Paytm is today not even having even 1% ownership by founders. Founders are totally out. Right? So all these things, you as a founder have a perspective on some of these new age businesses. And there are some of these businesses which are in the small and mid cap space, and which could be kind of maybe eventually over the next 5, 7, 10 years build a lot of wealth, or they may not build wealth. So I want you to kind of attempt and answer this aspect. What is your perspective generically on this category? And at the same time, if you want to cover any one particular idea or any particular business model, obviously we'll give disclaimers that there is nothing like we are giving any advice to anyone. Everybody has to do one's own due diligence. We're all discussing this, for education and learning purpose.
Yes, it's very interesting, because internally also we debate this a lot. So I have a few views. First is, many of these businesses will become bigger over the next 5 years, 10 years, because it's a thematic thing which is playing out. So for example, if we just take eating out versus ordering food in house, ordering food will keep growing as a business. And probably what propelled it even more was the fact that after COVID, people were in their house, nobody wanted to step out, nobody was allowed to really go out. And at some point you got bored with your wife's cooking, and so you wanted something out, so people ordered out. It's like my father would never order anything, like whether it was on Amazon or whether it was anything on Swiggy or Zomato, he would never. But in COVID he got used to it, so now he still does it once in a while. He calls food from outside. So just as a trend, it's something, a business which will keep going up. The second is, like, do we know who will be the winner in this space? And what you find is typically it's very, very tough to call the winner 10 years later. Though, today you think there's a recency bias that these are the players, they'll do well. But what you may find is 5 years later, somebody else has become the winner rather than this. And the third fact is that, at what price are you buying it at? And, that gets the most critical element because, a lot of these today, you're not buying with any visible profit. So you're buying it on some multiple. Uh, I've lived through a lot of these. So if I go back to, 2000, that time it was, all click will only work and no brick will work. And it was like all these clicks were there. People were paying for how many clicks have you got on your website. 90% of those companies have disappeared today. They don't exist also. So that is the risk which you have to take, that when you buy it at valuations which are very high, you have to be really sure you'll do this. So, just to give you one data point, so we are all on Zoom today, right? Zoom was not known to any of us till before COVID came. The Zoom stock has gone back to where it was pre-COVID, in spite of the fact that probably everybody in the world now is using Zoom as a norm. And we've all become, I do 4 Zoom calls in a day, and we didn't know it. So, you got a market right, you captured the market right also, but you still didn't make money in a stock because, you have to make ultimately sustainable profit out of this, and you just can't add the customer. At some point, people will pay you just for the number of customers you have, but after some time they say, okay, but where's the money in it? So that is, one of the big risks here. The last point is the survivorship. So for us, as a firm, one of the things I always do is, can the company go bankrupt? If a company can go bankrupt, we need to be very careful because, if we miss buying it, we lose some upside. But if the company goes bankrupt, we lose all our money. And, you lose money on one stock, it's very tough to catch. We need 3 other multi-baggers to really capture that one thing. So the problem is many of these new age stocks can technically go bankrupt because a lot of them work on, I'm making a cash loss, but somebody will keep funding me. In an environment where interest rates are no longer zero, but interest rates are high, you may not get the next round of funding as easily as you thought. And if that means that you start going bankrupt, then it's a worry for us that, okay, do we really want to take that sort of risk in the stock, or can we find something which is probably easier for us to do?
I'll take you diagonally to the now opposite direction in maybe understanding your viewpoint and perspective towards PSUs, because over last couple of years PSUs have also been doing really well. If I even see today, top stock is Coal India, or maybe NTPC, right? So all these stocks were kind of, I would say, big wealth destroyers, and with very very difficulty, many, I would say, investors have learned a lesson to invest in quality, to invest in growth, to invest in businesses where you understand the business model, where the objective of the founders or promoters is creating shareholder value. But obviously all these things are not there in PSUs. So I know, you talked about your dad. I'll talk about my dad. I remember he had been holding some of these stocks till 2010, 11, 12, and then for last 10 years they did nothing. And then obviously, I myself would have exited these stocks for him and would have converted that portfolio to some of these growth stocks where, stocks like HDFC Bank, Pidilite, Infosys would have been added. But now these stocks are expensive, but PSUs have been kind of doing really well. So it is a learning, it is an evolution. So I'm keen to understand from you from here onwards, what is the perspective that you have on the PSUs? I'm not wanting you to answer that why PSUs have gone up. Maybe you can attempt to answer that aspect, but majorly I want to understand what's the way forward.
Yeah, Kamal. So, what happens is value versus growth. And, it's like, you'll find alternate cycles where growth does well and value does well. And the reason for that is, sector preferences change, but they change partly because a lot of these get re-rated. So, if we just go back into history again, between 97 to 2000, tech was the best performing sector in India. And the worst performing sector was capital goods. And if you had done the reverse trade in 2000, basically you made a lot of money because from 2000 to 2008, tech was the worst performing sector and capital goods was the best performing sector. And again, from 2008 to 2020, capital goods was again the worst performing sector and tech and FMCG did well. So what happens always is once a sector comes into fashion, or once growth comes into fashion or once value comes into fashion, all these stocks get re-rated a lot. And with recency bias, most people then start believing, okay, so if I paid 30 times for this stock, then I think 30 is a fair number. But what you have to see is earlier you paid 15 times for it, and then you're now paying 30 times for it if you take the history. So what we saw was like a big valuation arbitrage, because between some of these growth stocks, which earlier, or let's say the FMCG stocks, which were trading at some point at, or they typically used to trade at 30, 35 multiple, they all went to 70, 75 multiple. Where the PSU stocks then were languishing at like 8, 10, 8, 10 multiple. So the differential became so high that people said, okay, if there's like a growth which starts to come in these also, then we are willing to pay it. And what we saw over the last 18 months is the growth in many of these PSUs in terms of earnings was probably as high as the growth in many of these FMCG companies. So suddenly you have like, I am getting a 12 to 15% growth in these PSUs at like single digit multiple, and I'm getting a 12 to 15% growth in the FMCG also at 75 multiple. So no, this may not be sustainable. This is sustainable managed qualities. Much better you say, okay, now we can re-rate these a bit. The other point I'll make is on the PSUs, it's like, it's a vast variety of sectors, right? So even now, like you can take some PSUs, like probably the oil PSUs. They're not done well. So, when we talk of all the PSUs, but, let's say the PSU banking space had done very well. Now, the PSU banking space has done well more because corporate banks in general have done well, right? So whether it's the PSUs or whether it's the private sector, which are more corporate oriented, they've all done well in this space because this whole sector went through a massive cleanup exercise. So whether it was a public sector or the private sector, they all had to clean up their balance sheet, and because of that, NPLs were just mounting. Reported earnings were very low. Once the cleanup was done, suddenly the reported earnings looked very, very good. So, that is one reason you saw like a massive re-rating of the public sector banks as well as, the corporate banks also at that point of time. So, some of that was like a sector link. Some of it was just the fact that the valuation differential became very, very high. And for us, this is a cycle that you'll always find cycles where one sector gets re-rated, and it gets re-rated probably at some point more than warranted from where it doesn't make money. There'll be some other sector which has got totally depressed, and that's what our 3Us is all about, that you get into under-owned and underperforming sectors which have become undervalued.
Sure. So, to begin with, you had mentioned that you see that specialty chemical sectors again, coming on your radar, and going by the contrarian view. That is one aspect, one theme, that you mentioned that is looking attractive to you. And at the same time, you also talked about that, yes, there are financial services as a sector will continue to do well. And within that, obviously, retail loans you talked about, because that has linkage to people borrowing more as they kind of try to adopt better lifestyle as, the income levels grow. Right. Then you also talked about, the fact that as the earnings of people grow, they adopt luxury brands, and in that context they try and kind of build bigger or maybe better houses. And then obviously in that space, the building material space and real estate and ancillary space will do well. So I think we have covered almost all sectors that I had in my mind. But one important sector which in that regards, as people become more and more I would say better in their standard of living, how and where do you see the future of automobiles? Because automobile as a sector is also over last 2-3 years being actually out of favor. But of late, if I was to follow three stocks, which is Tata Motors, Mahindra and Maruti, these are three top stocks that come to my mind. They show good resilience, and they actually have done well over last almost 2 years, when obviously small caps have done very, very well. But generally speaking, other large caps, because these three are kind of large cap stocks, other large caps in IT, in financial services, in pharma, in consumer, have not done well at all. But what auto has done well. Now, with auto as a sector is actually going through a lot of transformation, and I wanted to cover that. And maybe then auto ancillary, and then how EV, and then obviously how is your portfolio positioned, or are you holding any stocks, or are you having any perspective to add stocks in this area? because here, if there is any scope for investors to make money, where companies become from mid to small, from small to mid, and then mid to large.
Yeah. Yeah. So, Kamal, if you look at the auto sector, and just, when I said that 1/3 of the, small cap index has given return more than 50%, auto is one of the prominent things there. Now, it's a sector which generally is a bit of cyclical in the sense that you have a very weak, strong demand at some point and a very weak demand at some point. The sector has done very well in terms of pure numbers, in terms of the vehicle sales for the last 12, 18 months, because you were coming off a low COVID base. The other is there was a production problem because of the shortage of semiconductors across the world. So what you had was a long waiting list for autos. Now, on a very structural basis, there'll be much more auto sales 4 years later than what is there today. So very structurally, it's a very easy one that as Indians get richer, you'll have more and more auto sales. People will buy 2 vehicles, they'll buy 3 vehicles. And so, there's a big growth path ahead. Very short term, we've been a little more cautious on autos now. So we've been trimming our position in autos. And the reason for that is after seeing like 12, 18 months of very strong volume growth, one is the base effect will kick in. The second is now if you start thinking of the waiting list for vehicles, they've come down very substantially. So when there was a waiting list of 6 months for vehicle, what you know is the visibility of sales is huge because, okay, as soon as this vehicle is produced, they can do it. But now that waiting list has come down quite a bit. The premiums which we're getting on cars have come down quite a bit. So what we think will happen is that over the next, 6 months later, you may find that on a year-on-year basis, the sales numbers are looking okay, it's getting very, very flattish rather than this. At the same time, if you see the stocks have got re-rated quite a bit. So, just like we have the 3 U's which we do for buying, we have the 3 O's which we do for selling, which is overvalued, overowned, and outperforming. So, auto is starting to get into that sort of segment. And so to some extent, we've trimmed our position. We still like this sector as a longer term because it fits in with our theme that as per capita income doubles, what will people buy? The other point I want to make on autos is this whole debate on EV versus hybrid versus the ICE engine vehicles. And that's a debate which will continue to play out in future. So there may be different winners which are there from what today we have. Some of the players which win may be totally different from the majors which we are thinking of today. And that thing can really play out in future, which we don't know. Though globally now, there's a big question mark because the key thing with EV is not just you can make the EV, but does the whole infrastructure for charging happen in the country? And what is the model we want to approach is still up for debate. The other is, there's a subsidy element which is there from governments across the world when you're buying EV vehicles. That subsidy element at some point will be pulled back. So once you pull it back, then whether this sort of thing will play out even more or not. So within the auto segment, if we look at today, probably our comfort lies with 2 sectors, 2 sub-segments of that. One is still the commercial vehicles, where we think there's still some room to go, even though that's like the even deeper cyclical than the passenger vehicles. And the other is within the auto ancillary space. So the reason we still like auto ancillary rather than the auto majors is one is auto ancillary caters to a whole broad spectrum of people. And so if you have someone who's catering to 3-4 manufacturers rather than one, then even if one manufacturer loses share, the other gains share. You hopefully don't get disrupted too much on the auto ancillary. Second is, I think there'll be a lot more of outsourcing in the auto ancillary space. So, at some point we'll see all of them becoming bigger, not just because of the Indian market, because they capture a bigger and bigger share of what is happening internationally. So in autos, there are like, within that ancillary space, there's a lot of players you can find, which will not get disrupted if ICE engine disappears also. And that's what we always focus on. It is something very, very attuned to ICE engines. We try and avoid that. Because even if the business doesn't fall off, these stocks tend to get derated. But you have a lot of people now who are trying to do EVs also, who have some ICE engine exposure also, and who cater to the domestic as well as international market, which are reasonably priced and where there's a lot of growth potential ahead.
Sure. Jyoti, so I think we are moving to the last question for this webinar. And then you had mentioned that your approach at Valentis Advisors when you pick up small mid-cap stocks is a private equity lens, private equity way of thinking.
Yeah.
Right, which is like, I think one of the reasons that why and how Valentis Advisors has been doing really well. And my good wishes to you for the future.
Thank you.
But again, this opens another question which many prospective investors would have on their mind, that if they want to allot larger corpus to a Valentis kind of a fund, why not they look at maybe a private equity fund itself? Because today there are a lot of opportunities in category 2, mid-stage, early stage, or maybe late stage private equity funds, which are like pre-IPO funds. And there is this, again, I would say, sales positioning, or you can say a narrative going on in the market through various private banks who deal in selling or distributing these products, that by the time the small cap company reaches stock market, it is already very expensive. And anchor investor, who would have done investment before the company got listed would have already made money. They would be out. Now it is the piece which is in the hands of retail investors, and then obviously retail investors have to go through a big I would say turmoil, because very few companies in small caps actually do well when it comes to after getting listed. Yeah. So hence from that point of view, what is your answer to such an investor who is really confused? Should I be putting money to the unlisted space if I have to delve into the space of small companies, or I should be investing into a listed space? Because at the end of the day, one has to keep a 5-6 year horizon on both segments.
Yeah, so that's a great question, Kamal, and it's something we debated with a very large family office 4 months ago. And I'll make the 3 points I made to them, and some of this he vetted. So first point is, like, my thing to him was, have you made more returns in the unlisted space which you invested, or in my fund? And he did a like to like, and he said, okay, post fees, post everything, and based on like when I gave the money, we've made like similar sort of returns, or your fund has given me a better return than what the private equity fund has given. So one is you have better return there. The second is you have more transparency in our fund, in the sense that all the stocks are listed. There's a price which you can see. In the unlisted fund, you have no clue, because the stock is bought between one and the other, and the markdown suddenly are 33%, and at some point the fund which you're looking great disappears. And the third is you have more liquidity. Like, though we want investors to be with us forever, at some point, if there's an urgent need or unforeseen need of money, he can redeem from our fund. And, whereas in that private equity fund, he's stuck for 6-7 years. So basically, you get more liquidity, you get more transparency, and you get a similar or higher return. So that's what we really market. At the same time, again, I always believe in asset allocation. So people want to put some portion of the money in unlisted because they hope they can hit one of those winners. You should do it. But like our fund is like, like a quasi unlisted play, which looks at companies which are all listed, and so it just gives you more transparency and liquidity. Kamal, I think you're frozen. Yeah.
Sure.
Yeah.
I think there's network lag.
Yeah, there's network. Yeah.
Yeah, but there you have covered more or less. So, basically, you are saying that you leave it to the investor to ultimately decide his asset allocation. But yes, the risk adjusted return, if one has to kind of calculate on those grounds, listed space throws better experience and better opportunity for investors, because it is more transparent, it is more liquid, and at the same time, the landscape has far more diversified portfolio for one to build wealth over longer term, and compounding can happen for more number of years. So obviously, I agree and understand to that aspect. So, we have more or less covered this webinar, because we generally keep 1 hour for it. But
Yeah.
just for a closing remark, from your point, from your side, as a final piece of advice that you want to give to various clients and various investors, especially over last 3-4 years, who have come up and started investing in the space of small caps, mid caps through mutual funds, because we have seen many mutual funds, I don't want to take names, have actually mounted their AUMs in the small cap space and mid cap space, and AUMs have grown to levels of like 40,000 crores. So obviously, it's because many new retail investors have come up and they have been investing in this space, because obviously the space has been rising for some time. So this is the last, I would say, question for you, Jyoti, because you have 3 decades of experience. I want you to give your perspective, because there are some HNI investors also who are also kind of seeing that if one can make good returns in a small cap mutual fund, which is like returns upwards of 25% per annum, why should one actually look at a space of small caps or mid caps?
Kamal, I think there's a network issue, but probably I think I've understood your question. So let me attempt to answer it. One is we've compared our returns with all the mutual funds, and most of the we have beaten the mutual funds over the 3-year period. I think we've beaten probably all of them over the 3-year period. The second thing to invest in us versus a mutual fund is that we are very, very smart managers in the mutual fund, but just the size of our assets, like as we all know, and this is true globally across like probably 50 years, 100 years, as the size of the assets, as the AUM goes beyond a point of time, returns start to come down just because of the difficulty of entry and exit into a lot of these stocks. So I think that is the critical thing for us, that we are small. We prefer to remain small, and so we are able to be more nimble in the stocks which we can invest in. And so that's reflected in the returns, where we probably beaten all the mutual funds over the year period in terms of our returns.
Right, Jyoti, I think it has been really pleasure conversing with you. I think you have been able to cover almost every aspect that I had on my mind, and it will be really kind of, I would say, again, insightful conversing with you. Maybe once we see markets at a better valuation, and the kind of play, the kind of projections that you have given over the next 1 year in terms of the optimism, again returning to equity markets in a more healthy way, whereby we have a longer room in terms of valuations in your space of small caps for it to make money. And we'll be again kind of doing that webinar maybe in a different manner with you to understand now from here onwards where and how wealth will be made. But it's an ongoing journey. I understand the kind of context that you have shared, whereby even if one misses one good month, one is taken back by 9 to 10% of returns, because obviously that's how the space of small cap is, and hence one has to remain invested at most of the times and leave it to the fund manager for fund manager to take whatever cash call fund manager wants to take. And we always give the same perspective to our clients, but still, because it is hard earned money and investors are obviously human beings, and there are sentiments and emotions. So obviously investors kind of want to understand always the perspective of a fund manager, to kind of give again and again a reminder on not to time the market, maybe be in the market for long. That is the larger context which we wanted to cover as an objective in this webinar. Few I think people in the audience were asking what is the objective of this webinar. We were not wanting to sell any product. We were not wanting to market or say that yes, one should invest in the space of small caps. We have not at all talked about returns of Valentis. We leave it to all the participants to go and check on our platform PMS AIF World. What is the return of Valentis? In fact, beyond returns, we have a lot of numbers like beta, Sharpe ratio, information ratio, and one can do a lot of good comparative evaluation. And if one wants better support to make better informed decisions, one can book appointments with us. And we really look forward to serving more and more clients. We already have more than 300 HNI, ultra HNI clients, including NRIs, whom we are serving. And then we kind of take this rhythm of doing weekly webinars on ongoing basis to keep adding value, because markets every week bring some good news, some bad news, and both good news and bad news is a matter of confusion. And hence it is important to keep sharing perspectives and views, to keep learning and keep kind of, I would say, reiterating wisdom. And that is a larger context of doing these webinars. And I really thank you, Jyoti, for sparing your time today on Friday afternoon for doing this webinar with you. It was really insightful conversing with you, and thank you everyone for joining with us today.
Thanks a lot, Kamal. Till next time. Bye to
Absolutely.
everyone.